Hey everybody, good afternoon. This is Doc Severson, and I'm joined by Dave Lukas here of 12 Minute Trading. Today is Monday, the 18th of March. We are into the third month of the year already, and we're still on the same rally that we've been on since October, surprisingly, and wondering when things are going to go here. And we're approaching our next Fed meeting in a couple of days, so we have all kinds of uncertainty. The market has been incredibly choppy lately, and just we haven't broken trend, but at the same time not going anywhere. So Dave, what are you seeing happen in the markets these days?
Well, we're either in the midst of a character change or this is how the market's just charging itself back up. And instead of pulling back, it's just going sideways for a couple weeks to continue going higher again. The Fed is, I think, going to be the catalyst for the week. Today's move is really interesting. You and I were talking about this beforehand. After the 3 days last week selling down and stuff, I thought we might have a little bounce today, but it's like, oh, let's go up, 1% on the fact that Nvidia is having a conference
Yeah.
and stuff. I don't think that's it. I think this could be a little bit of pump into the Fed to maybe dump from the Fed if the Fed changes its tune. That's the big thing this week, right? So the Fed has been sitting there going, we're going to cut rates at some point this year. We don't know when, but it's probably going to be 3 or so. But the last two inflation prints, especially PPI, really, really high, right? From a PPI standpoint. So, and you have an economy that seems to be doing well. So how can the Fed really cut rates at all? And I don't think the market is ready for the Fed to come out and say, hey, you know what? We may not have to cut rates this year, and so I think the key things this week are going to be when the Fed, does its thing and the dog and pony show all starts. It's going to be, does the dot plot change, right? The dot plot was 3 cuts. Does it go to 2? That's the first thing. And then what's the language look like from the decision and everything else, right? And is that more hawkish? And then if Powell backs it up and is hawkish in his speech and doesn't waver, then maybe you get a little bit of rigidness in the markets. They start to freak a little bit, right? And we're watching, we were just talking, we're watching the energy charge up, right? This chop is doing nothing but charge the energy up in the charts. And typically when you get to the levels of charge that we have, like on a daily chart, it's ready to trend. So it's no surprise, right, that the market's just going nowhere until the Fed decision, and then it's going to trend. I mean, that makes a lot of sense to me. But I think we're going to get a pretty massive trend out of this. We're either heading, like 4,300, or sorry, 5,300 out of this, or we're heading to 4,900 out of this. That's the amount of energy that's there to really utilize here.
Is there something that Powell might say on Wednesday that's going to break the market one way or the other? Is there something that you think that he has been holding back and
I don't know. I think he's so wishy-washy in press conferences and stuff that he would have to be pretty definitive in this. He hasn't been that way, and that's why things keep going higher. I think he's got to come out and say, basically, look, you may think X, Y, or Z, but that doesn't mean it's going to happen, right? Like he's going to have to be more forceful in his statements and say, we're not seeing evidence to cut rates yet. And inflation's going higher again. Like it has to be something that markets just would not expect from him, right? He's got to change character a little bit. That's, to me, would be the thing that would really spook markets.
I mean, to me, I can't see the market being surprised by him being hawkish on Wednesday. He would say, look, based on recent inflation reports, we see a second wave coming on. And so maybe
that's
we're
why
not
the
going
dot plot has to change and everything,
right.
And the language has to change. The dot plot has to show less hikes, and you got to have more forceful language, coupled with Powell being like that, and maybe you get it right. And unless we're at a point where the big boys want to take, some profits off the table for the quarter. That's the other thing that that we have. We've got another week or so, and it's the end of the quarter. So if you want to lock in gains for the quarter, and you're a big player, you'd start making some of those moves, and you'd have an excuse to make some of those moves, right? If you want to lock in those gains. So that's something that it can just be used as an excuse for. But I've been saying this, and I think you've been saying it too. The trend is really, really easy right now. And I've been saying this on my setup at least, and it's very evident. If you have that, I think we went through this last week. If you've got that standard Bollinger Band set up with a simple moving average, you look at the S&P, and until that moving average line is broken, this trend isn't changing. What did we do? We went right down to the moving average line as of Friday. And what do? We bounced today right off that thing. And if you look at this trend from the very beginning, all the way back to where it crossed that line in October, that has been the support every time we get down to it. So until that line breaks, you have to just suspect this trend to continue as it's doing.
You got
it right there.
Yeah, this is the moving average, and the blue line here is the 20-period simple.
20-period moving average. And it has, look at that. Every time we come down to it, bounce, that's to me is like, once that breaks, if that line breaks, then you're going to have that change.
We've got your classic divergence on the MACDs, but it's been going on basically since the beginning of the year. So that's more of just a context for what's going on and not necessarily a signal. So
and if you throw in the NDX has a little bit of different pattern. It'll dip below it and get close to the lower Bollinger Band, but it won't break through it. And so to me, breaking through the lower Bollinger Band is what the NDX has to do to really, show that it is changing its trend and polarity. It gets close, it gets down to there, but it does not break through it, right? So, that's why, like, the trend was heading lower. Look at the divergence, look at the MACD. Trend was heading lower as of Friday. We get the bounce today. We'll see what holds into the end of the day. Maybe we end up at the highs of the day, or maybe we sell off a lot coming into the end of the day here. But ultimately, those are the things that have to break. So you've got to see like 17,500. You've got to see a break below 4,100 that's sustained on the SPX for this trend to change. So really easy.
One of the things, just from a price perspective, looking at this is a classic, absolutely classic pennant pattern that we've set up here. Mm-hmm. So you're seeing a series of slightly lower highs, and you're also seeing a series of increasing higher lows. And so this does nothing but kind of wind things up again. Now, a lot of times what people will do is they will expect to see the breakout from this. The favorite signals that I've ever seen from this are ones where everybody's expecting the breakout to the upside. And what happens instead is there's a catalyst that comes along, and then it very, very rapidly shoots it down. So this is going to be it's not going to be based on some kind of Fed statement on Wednesday, because everybody's so used to that. It's so baked into the market right now. This could be something where we have a geopolitical event which has not been predicted. This is completely new information that the market has not discounted. And this is where we could find ourselves very quickly down here at 4,900. Now, these types of moves also tend to charge things up very, very quickly. So people are waiting down here, are very patiently waiting down here with buy orders and demand. Mm-hmm. And that demand can, right around the time that everybody's getting comfortable with being short, can flip things around in a hurry. This would almost be what I prefer to see in the short term. Something like this. I actually do not want to see a breakout to the upside of this triangle pattern, because that would be...
it would be healthiest to take that little pause lower.
It would be very healthy, because if you look at this like on the weekly chart, if we go out to the weekly chart, and if you say, okay, what would be normal here? What would be a normal pullback here? And, looking at something like this, saying, what would be normal here? This actually would be a normal pullback that we got. This would be a normal pullback to see something like that. And I believe that would be almost a 38.2, which would be almost perfect, a 38.2% retracement. So, yeah, that's kind of what, I think everybody's kind of in the same boat here. We're all waiting staring around, waiting for something to happen, and it's not happening. But we've been through this before. I mean, if
Yep.
if I want to play the time machine thing here, I can go back to if we go back, max available, starting to get around in a long time. So we've seen moves like this before, where this was a classic one, where we just went on and on and on and on, literally for 6 straight months, from July all the way up to around February. And look at the move that we had. A shock move to the downside. What happened from there? Higher highs. Breakout, shock move here, higher highs. This is what always happens. So we want to see the shock move. This is where we get the most consolidation, the most energy restoration from something like that. And this is where you build into much deeper demand for these. Remember, this is, this is for all those folks out there. And by the way, if you have any questions, please let us know. This is an uptrend, and a lot of people forget. They come along with the first red candle and they're like, oh no, here we go, S&P 1000. No, this is why we say rule number one of fractal energy trading is that larger time frames dominate. So when you get a monthly or a weekly chart like this, yeah, you're going to have moves like this, but eventually they're going to revert back to the mean in the mean direction here. So
yeah, and again, that's a healthy thing for this market. Looking at this trend, the more parabolic you go, the worse it is when it collapses. So the healthy thing for the market is to have a little pullback to a higher low and then continue the trend, right? That's what you want to see to really continue a bull. Because if you just keep going parabolic straight up, eventually, when that comes down, it's just a collapse, like a building falling on itself, right? Same type of thing. And so that's what I think we have to be conscious of with this. And I don't know. Yeah, I don't know if the Fed will be a catalyst this week or not. The energy is sure there to have that type of move, right? The energy is there to do 150 points on the S&P, in a few days if it wants to. We've got it charged up enough for that. I think, you're talking about geopolitical, other things. Japan, for the first time today, stopped with its yield control. So there will be an impact from that at some point. Rates are allowed to rise now, and they're kind of stopping their liquidity into the markets and things like that. I don't know if that will have an impact. Remember, the carry trade is that people were basically borrowing money from Japan and putting it in U.S. bonds and stuff because they were getting the arbitrage of doing that, right? And so. Does that mean that stops now because Japan bonds start to have a value that people pay for, right? So, I don't know, but that's something that, overnight you can wake up and have some screwy things go on with something like that. So, yeah, we'll just have to see what transpires. That's what I told my students. I was just not trading until Friday. I'm just not trading anything until Friday this week. Let it show its hand. Let it tell us where we're going to go and take advantage. And that's, these are good weeks for that. It's a good week to just sit back and let the market dictate and tell you what it wants to do.
Yeah, speaking of parabolic markets here's Bitcoin. And Bitcoin is, this is where everybody is like, Bitcoin is one of these amazing markets where it's, you just get so many retail traders. When you double in the span of a few weeks here, just about doubled in the span of a few weeks, this is where you get some amazing investor interest. I think we are going to be setting up for a big cup with handle setting up here. So I think there's going to be fairly strong demand floor from all that capital coming in through the ETFs. That is, like IBIT is the biggest one right now. So this may be we may be stuck in a summer handle here. And then eventually what we would expect to see is this distance that goes in between the very bottom of the cup up to the neckline, that change in price is what you append as the measured move to the upside, which last time I checked was about 122K. So I think for those of you that are out there interested in Bitcoin, I think you've got a few weeks here to accumulate at lower price levels before this thing takes off. We
Yeah,
got
it may drop a little bit more. I mean, you've seen that before. I mean, look at the last real spike there, and it came down. I don't think it's going to come down that far because of what you just said. But again, it's just a sign of what happens when you go parabolic. These things happen. It's just hard to sustain that. It's just you run out of gas effectively at some point. So,
this was
um,
this move over here had so much leverage behind it. All the moves over
yeah,
here just had massive leverage behind it. They did not have any ETFs right now. There's no leverage on the ETFs. There's no options. So that to me gives it a more stable floor than what we had before, because it was very, very thin markets that were over leveraged with people that didn't know what they were doing. So we got
yeah. In
a
fact, examples of things that like even that and just talking right now, while we've been sitting here, Doc, a nice little buy program hit the tape on like the SPX. We'll see if it rebounds, but that's what I'm saying. I don't know. I don't know about today's move. Today could just be that again, that pump into the Fed and then they sell it off and take the money off the table and fade the retail investors. It just seems like it just seems like it's too easy.
Yeah, it is. Notice the anchored VWAP today is perfectly showing
Yeah,
resistance for everything. So we actually traded
good point.
we traded the zero DTE in the room today. We had a nice opening range. We got our entry right around here, and I took a little heat to the upside, but I felt that this was going to be coming back down, and so it was about a 40-minute hold for zero DTE, which is about normal for $50 a contract. So that was a good trade. We got a question that just came in from Brewhead here, and he's talking about how do options compensate when they go ex dividend. It's not so much the is it the ex dividend? Yes, it is. It's the date is ex dividend. Here, let me go
Yeah.
to.
Yeah, it's when the SPY, it gets thrown off because of the dividend for the. I don't think it does much to the options because it's usually not that much. It's like a point or so.
So yeah, we just had an ex dividend date on Friday of 315, and so what happens is this price gets taken out of the actual underlying. So you can see this happening if you go out to the SPY, and let's go
Hmm.
to something less than a week here. Let's see. You can see it. Let's see, 314, 315. So apart from we did have a little bit of a gap down, but a lot of this gap that's in there is actually the dividend being taken out of the
Yep.
spiders. So that's one difference that people don't understand between the actual SPX and the spiders is that you have to wrestle with that dividend. So the same thing happens. There's no real specific. The dividend price is taken out of the options as well too. So a lot of people will say, "Hey, man, if I know that this gap is going to come along on Friday, I'm just going to buy puts on the Thursday, and then I'll get an immediate profit." And then they're surprised to see that it's already baked in.
Yeah, that's what Brewett's saying now. You can just you get that
Oh,
little, yeah, you think, yeah, no, they're smarter than that. So
right.
it gets baked in, so you don't get that. And that's why I said it doesn't really make that much of a difference or anything. So
It's funny that you mentioned it, because it's like I think I spent my first year before I went solo. I spent a year like trying to game the system. Like, oh, okay, now I know understand options. Like, okay, can I write these covered calls? And it's like there's a huge credit here. I wonder why that is. And it's like I would write a call, and all of a sudden it's like, oh, they just got acquired by somebody else. I didn't know that, and so I'd have to sit in something for 6 months. So the general rule is if you see something that looks like it's too easy, then it's
everybody knows it.
yeah, everybody knows it, and it's not too easy. There's very, very little. One of the things that goes back, maybe 30 years or so is like, look for mispriced options. Bullshit. I mean, there is no such thing as a mispriced option anymore. The only thing that we see in terms of mispricing is especially when markets drop like this,
Right.
the implied volatility will go sky high. It will misprice the option in terms of just the emotion of it. And so that is the one consistent thing that we've done over the years is when we see the fear, we sell into the fear. And it takes a while to get used to because it is scary. But that is probably the most consistent edge that's out there. So if you want to talk about mispricing, but it's like that's where Sam Bankman-Fried made all his initial money was arbitrage between the crypto exchanges, all the different exchanges. They were all running around at different prices. And so he would buy here, sell there. And there used to be programs that would do that on the options exchanges, like the different one, the NYSE, the CBOE, the BOX, all the different exchanges, the PacBell, all the different exchanges out there would try to arb the options in between. But now they're running on, Cray computers with no band, literally right next to the point of presence on the internet provider or right next to the exchange. There's no time delay at all. And it's just.
And I think I've said this before too. Don't make the mistake to think that you can be better than the quants and the big hedge funds. And these guys are so far ahead when it comes to extracting value from a market. There's just, it is impossible to compete with them. I mean, these guys are spending millions of dollars to run fiber, in a specific way to their offices so a trade executes 1/1 millionth of a second faster. You know what I mean? So like that's the thing I realized a long time ago. If you're trying to compete in that's a very red ocean, and that's why I love selling iron condors in a range. Why I love looking for ranges and just selling iron condors against them, because I don't have to compete with those guys. Like, let the price do whatever it wants. Extract your pennies, do your thing, right? I don't care. I'm just going to say, hey, you're going to stay between this and this for that time period. And, and that's what, they're high probability trades, right? So, 96, 97%, a chance of winning. And, that's about what it equates out to. So you got to understand for the one that goes against you, how to manage it when that happens. But for the most part, it's pretty boring and consistent, and that's that, you don't have to deal with all that stuff. And that's why I like trading that way.
There's one guy I always like listening to, and I'm not alone with this. Tom Sosnoff is well thought of across the industry, regardless of whether you like his platform or not. But I always find that I learn something from listening to the guy. So half the time he's just joking around and, talking about what cheeseburger he's going to get for the weekend. But at the same time, I think he's got a good beat on what it takes to become a retail trader. The last time I was in New York, he was speaking at a conference out there, and his thing was like he was on a rant about social investing. Now, social investing to me is being part of a Discord, being part of some kind of Wall Street bets, or being part of a subreddit or some other collection of like, hey guys, what are we going to trade today, kind of thing. And then so everybody goes swamps into it. And he's like, guys, if you do that, how are you maintaining your independence? He goes, what we've always believed in is that the biggest edge that you have as a retail investor is being able to go in the opposite direction as everybody else. And that's something that you and I have believed in, like, that contrarian sense of like selling into the fear. And when things are getting frothy, then we take the other side of that, trying to find out exactly what the market's giving us in terms of edge. And it does take a while to learn that. It's not something that comes easily, because we are herd animals. We are creatures that, my favorite thing to do is to go into a football stadium with 100,000 people in it and cheer my team on. Love doing that, right? But it doesn't work in the market when you do something like that, because you're going to get the same performance as everybody else. And the only way that you're going to find that superior performance that we're all looking for is to be that solo individual walking the other way from everybody else.
And I have to say, even being the solo individual walking the other way and doing that, you're going to find some things that work really well, pretty consistently for most of the time. but markets will challenge you
Mm-hmm.
because they will change. And there will be those instances where it doesn't work as good or doesn't work the same. And you have to be willing to adjust to that and stuff, because there's nothing that is foolproof. There's always going to be a loss at some point in some way. It's just how good are you at mitigating that loss, when that time comes, right? So, there's no 100% perfect anything. And so I think I think a lot of people are out there looking for, like, we always say, like, the holy grail, but people are looking for that strategy or that program or that guru or whatever that's just, it's always going to work. And that's not the case. Like, that's one of the reasons, like, we love the campaign trade, right? And we love it because it does self-defend and everything else, but it doesn't mean it always wins every single trade. It's not going to win 100% of the time. It's just not going to lose a massive amount when it loses. Like, that's the benefit of it, right? And so I think, people have to be careful, because that's what causes problems, because they jump from one thing to the next looking for that, and it's not there. It's never going to be.
Yeah, I went into this concept the other day in my trading room, talking about the dip, which is a Seth Godin. I've sort of twisted the meaning of it just slightly, because to me the dip is that you start off in a new venture and you get all excited, you're full of enthusiasm and everything is going good. You see the mountain you're supposed to climb in the distance, and you're heading towards it, and you're coming towards it really fast. And then, so you can't lose. And then next thing you know is the dip. This is where you come into reality. All of a sudden the market character changes, things change a little bit, and then what worked perfectly before no longer works. This is where most people quit and say, well,
exactly.
This sucks. This doesn't work anymore. So let me go find that thing over there. Let me sign up for that guy's program over there. And people, I just see this going through this internal loop of, learning a little bit about something and then learning a little bit about that. And so they become a jack of all trades and a master of none.
Mm-hmm.
And so they never really truly apply themselves to learn the edge.
Well,
when they get to that point.
It's never just one, right? I mean, there are strategies that I like and I do through just about every market. They work better in some markets than others, but it's the ability to take different ones that pair together really well and help balance it out, right? So, like, for example, we trade, our own fund account together, right? And over the last, when we start getting this chop with these moves, like 40 points up a day, 40 points down the next day, we're not going anywhere, but we're up 30, 40 points. That's changed how the campaign trade has to work. Like, we were like every 3 days hitting 20% for a while, right? And so, but what's worked really consistently during that time is iron condors. Because go ahead, chop around. Go ahead, do whatever you want, chop around, but you're not going anywhere. You're not trending. And iron condors just love that. They just that time just eats away at that price. They work really well. So we balance that account out really nice, having those trades, keeping it profitable, not losing, growing it, and it's just really nice because you've got these two things working in tandem really well together. Now, when market's going up, the condors work too. They don't profit as fast, but the counter profits a lot faster, or the campaign, profits a lot faster. And so you're just racking up those profits from that, right? So you can pair together strategies in a lot of ways that they balance each other out, and they help to create a consistent money-making strategy, no matter what the market does. But it's that taking the time to learn how to do that is where the real skill is.
Yeah,
and doing this for 20 plus years, guys, does.
Yeah, there's a couple of other things too that I find helpful for people. There's a lot of analytical folks that are out there, engineers, doctors, airline pilots, whatever you want, accountants, and a lot of them are forever in this mode of getting ready to get ready to get ready. Because what they're doing is they're studying, they're analyzing, they want to make sure they get it perfect because they're looking for the perfect strategy that never loses because they're afraid of loss. They won't tell you that, but you can tell when you talk to somebody that when they're getting ready to get ready to get ready, they're afraid of loss. And to some degree, what you've got to do is you've got to get in there You got to get in there, roll up your sleeves, and duke it out. But when that happens, what you have to do is you have to complete the circle. You have to go through that strategy, and you have to learn something. What is the root cause for that strategy to either provide a profit for you, or why didn't it work? So instead of just writing it off and just saying, hey, well, that sucked. Okay, I'm not going to do that strategy again. Why didn't it work? What specifically happened that caused it to not work? And once you peel back the root cause of a trade and understand it, then you're going to feel more ownership towards it. And you're going to say, all right, I see what happened this time. I know exactly what to do next time. All right, so I won't make that mistake again. I'll do it again. And this is where the magic happens. This is where you get ownership of that. Yep. And this is something that we're always on about.
Yeah, no, it's a great point too, and all that. So, I mean, I think guys today, I mean, we talked about a lot of stuff, but I think if you really, if we want to kind of boil it down for you, I think the important thing for all of you to understand as you grow in your trading career is that you're going to find different strategies that work. And they're going to work for periods of time that, you'll start to think, oh, this is it. This is the strategy. It's never just the strategy. But if you can find 2 to 3 or 4 of those that are like that, and you pair them together in the right way, they can create a nice, consistent business for yourself. And you'll start to learn, and you won't learn it right away, but you'll start to learn that when to deploy which ones, or when to go more in on ones than others, right? Capital wise and stuff like that, based on your experience over time, watching the ebbs and flow of the market. And I think that comes with understanding market character over time. Like I said, when we started today, little different market character. We've been trending. Now we're sideways, really going nowhere, but it's kind of big swings, right? So iron condors do really well in that. So I've increased my iron condors, but that may be short-lived. When this daily energy breaks, if we start trending upwards, especially again, I'll pare back the contracts on those, or I'll weight them, to the side of that the things are trending to. I'll weight away from that. So, for example, I may weight if we're breaking upward, I may bring the bottom side up higher and put the top side a lot further, make it run up to it, and it equates to the same amount of money I'm making, but it's not the same as if I just put it on with a price in the middle. Right at the same levels, or the same levels that I sell at. That would actually get that trade in trouble. You learn how to manage that stuff, and that's kind of what we do, and that's what we do, like in our services and stuff, is we provide that teaching and that level of expertise from really experience, guys. That's what it comes down to. There's doing this 20 plus years.
There's so many different ways to skew things, and you've got to have something that you believe in, because if you don't believe in the trades that you're putting on, your subconscious mind will find a way to yank the rug out from underneath. Well, I just decided to take microscopic profits today because I was.
Shameless plug for you. That's the holy grail, is getting control over your subconscious mind, which your book is about.
Yeah, that is true. Yeah, I'm still working on it. So it is. No kidding. It is a lifelong. The human being is not. Trading is an unnatural act, because what you're doing is you're taking something that you've worked very, very hard to accumulate, which is risk capital, and then you're putting it under risk. And it's like letting a child go play out in the freeway. It's the same thing. I mean, it's not something that comes very natural to take that risk and feel comfortable with it and to do the right thing. Okay, we have gone from one end of the spectrum to the other in trading today. So I hope it's been educational for you guys and use of your time. And for those of you that are watching this on the replay, thank you very much. We appreciate you. And let us know if there's anything else that we can cover for you in future editions of this. So from Dave and myself, Doc, I wish you guys a great Monday, and we'll see you again in the next one.
Thanks, everybody.
Bye now.